1956, a 25-year-old man sat down and wrote a letter, not to a bank, not to an investor, to himself. In it, he laid out exactly how he would think, how he would act, and, most importantly, what he would refuse to do. No matter how much money was on the table, he sealed it. And for the next 70 years, he followed it almost word for word. That man was Warren Buffett. And that letter is one of the least talked about reasons he became the greatest investor who has ever lived. Not a secret formula, not insider information, a decision made once to never let emotion overrule a rule he'd already written down. Today, that same man is worth over $100 billion, and he still lives in the same 5-bedroom house he bought in 1958. No gates, no island, no yacht. We're going to open that letter, in a sense. We're going to take apart the actual thinking behind Warren Buffett, the mistakes he doesn't like to talk about, the one habit that quietly built his empire, and the exact rules you could start using today. Before we get into it, if you're serious about actually understanding money instead of just watching it move, hit subscribe. This channel breaks down the real stories behind the world's richest minds every single week. Now, let's go back to where it all started. 1930s Omaha. America is in the middle of the Great Depression. Banks are collapsing, fortunes are vanishing overnight. But inside one small boy's head, something strange is happening. While other kids trade marbles, young Warren Buffett is trading numbers, counting license plates, counting words in the newspaper, counting anything he can get his hands on. By 6 years old, he's buying 6 packs of Coca-Cola for $0.25 and reselling each bottle for a nickel profit. A small margin business running out of his grandfather's grocery store. At 11, he makes his first real move. He buys 3 shares of a company called City Service Preferred. The price drops almost immediately. He panics, like anyone would. When it finally creeps back up, just slightly, he sells for a tiny profit. Then he watches, helpless, as the stock keeps climbing, far past the price he sold at. That single afternoon becomes one of the most expensive
lessons of his life, and it costs him nothing but regret. Patience, he realizes, is worth more than a nervous, quick exit. It's a lesson he will spend the next 80 years proving, over and over again. Years later, Buffett is sharp, hungry, but still missing a system, not instinct, a framework he can trust when fear or greed try to take the wheel. He finds it in a book, The Intelligent Investor, written by a Columbia professor named Benjamin Graham.
The idea inside changes everything for him. A stock isn't a flickering number on a screen. It's a small piece of a real living business. And every business has a true underlying value, completely separate from whatever mood the market is in that day. Sometimes the market is euphoric and it overpays. Sometimes it's terrified and it undersells. The job of a real investor isn't guessing where the price goes next. It's figuring out what the business is actually worth and buying it when the market offers it for less. Buffett is so obsessed with this idea that he moves to New York just to study under Graham directly and becomes, by his own account, Graham's best student. He walks away with a phrase that will steer every decision he ever makes again. Price is what you pay. Value is what you get.
Here's where the story takes a strange turn. In 1962, Buffett starts buying shares in a company most people wouldn't look at twice, a dying textile mill in New England called Berkshire Hathaway. American textile manufacturing is fading fast, crushed by cheaper overseas competition.
He doesn't buy it because he loves fabric. He buys it because it's cheap relative to its assets, a classic Graham-style bargain. But then he does something far more interesting than just running a mill. He turns Berkshire into a shell, a machine. Its cash becomes fuel to buy other businesses, insurance companies, candy makers, furniture stores, railroads. Each business throws off more cash, which buys the next business, which throws off more cash again. It stops being a company.
It becomes a snowball, rolling downhill, picking up more snow with every single rotation, which is exactly how Buffett himself describes it. Find a wet enough surface and a long enough hill and let time do the rest of the work for you. Here's a number that puts that snowball into perspective. $1,000 invested in Berkshire Hathaway in 1965 would be worth well over $30 million today. Not from one lucky bet, from 60 straight years of the same snowball, rolling without stopping. So what are the actual rules inside Buffett's head? The parts everyone quotes and almost nobody actually follows. Rule 1. Circle of competence. Buffett refuses to invest in businesses he doesn't deeply understand. For decades, he avoided most technology stocks, not because he thought they were bad businesses, but because he couldn't confidently predict where they'd stand in 20 years.
He'd rather earn less inside his own expertise than gamble outside it. Rule 2. Buy the business, not the stock. Most people see a ticker symbol, a number that moves. Buffett sees a business. Employees, customers, competitors, cash flow. If you wouldn't buy the entire company at that price, you shouldn't buy one share of it either. Rule 3. Margin of safety. Never pay full price for your own estimate of value. If you believe a business is worth $1, don't pay 95 cents for it. Pay 60. That gap is your protection for the moments your judgment turns out to be wrong. Rule 4. Time is the real multiplier. This is the one most people underestimate. Buffett earned over 90% of his entire net worth after the age of 50. Not because his strategy suddenly got sharper, because compound growth needs decades to look dramatic. In year 5, steady growth looks unimpressive. In year 50, it looks like magic. He didn't get rich by picking one perfect stock. He got rich by simply refusing to stop. Rule 5. Be fearful when others are greedy, and greedy when others are fearful.
When markets crash and everyone sells in panic, Buffett buys. When markets feel invincible and everyone's euphoric, he pulls back. It sounds simple. Almost nobody can actually do it, because it means fighting your own fear at the exact moment that fear feels completely justified. 5 rules. Simple enough for an 11-year-old to understand. And yet, as we're about to see, even the man who wrote them got badly burned for breaking his own advice. In 1988, still shaken from the 1987 market crash, Buffett does something almost nobody else is doing. He quietly starts buying Coca-Cola stock. Not because it's exciting, because he understands it completely. A simple product, a global brand, a business that will likely be selling the exact same drink in 50 years. He eventually invests over $1 billion, a position that becomes one of the single most profitable stock holdings in modern financial history. Then comes 2008. The world is in financial freefall.
Banks are collapsing overnight. Investors everywhere are selling in blind panic. And Buffett starts writing checks. Billions into Goldman Sachs, billions into General Electric, at terms most companies would never dare accept, essentially betting his own fortune that the American economy would survive its worst crisis in generations. He was right. Those crisis-era deals became some of the most legendary trades in Wall Street history. Proof of the exact same principle an 11-year-old boy learned watching a stock he sold too early. When everyone else is panicking, that's often precisely when the real opportunity is standing right in front of you. Here's what actually separates Buffett from most people who claim to admire him. He talks about his failures louder than his wins. In the year 2000, Berkshire buys Dexter Shoe Company for over $400 million, paid not in cash, but in Berkshire stock.
Within a few years, Dexter is completely wiped out by cheap overseas manufacturing. Worthless. But here's the part that matters. Buffett didn't quietly bury the mistake. In his own shareholder letter, he called it, in his own words, one of the worst deals he had ever made, and admitted that because he paid in stock instead of cash, the true cost of that single error was actually in the billions. He stood in front of thousands of his own shareholders and owned it completely. No excuses.
He's also openly admitted he moved far too slowly on some of the great technology companies of the last 30 years, a mistake born directly from Rule 1, staying inside his circle of competence, even when that same caution occasionally cost him enormous gains. The lesson isn't that Buffett is infallible, it's the opposite. He was wrong, repeatedly, in ways that cost real money, and he still won in the end. Not because he avoided every mistake, but because his winning bets were left alone to compound for decades, while his losing ones were cut, admitted, and left behind.
Today, Warren Buffett is worth over $100 billion, and he has pledged to give away 99% of it, most of it through the Giving Pledge, an initiative he co-created to encourage the world's wealthiest people to donate the majority of their fortunes. He still lives in that same house in Omaha. He still answers questions from ordinary shareholders every year at Berkshire's annual meeting, an event so beloved by investors, it's nicknamed Woodstock for capitalists. He never built this empire to show it off. To him, the process itself, reading, thinking, waiting, compounding, was always the entire point. So what can you actually take from all of this? You don't need Warren Buffett's billions to use Warren Buffett's brain. You need patience most people simply don't have. You need the discipline to understand what you're buying before you buy it. You need the nerve to stay calm while everyone else panics, and the humility to stay cautious while everyone else feels invincible. Buffett didn't build the greatest investment record in history with a hidden trick. He built it with time, discipline, and a handful of rules simple enough for an 11-year-old to understand. Rare enough that 70 years later, almost nobody has managed to fully copy them. The question was never whether you're smart enough to invest like Warren Buffett. The real question is whether you're patient enough. If this broke down something you didn't know before, that's exactly what this channel is built for. Subscribe so the next story like this one doesn't pass you by.